SoFi CEO Anthony Noto participated in a fireside chat hosted by JPM just yesterday. On that fireside chat, Anthony Noto dropped some interesting insights. Among those insights were the fact that number one, over the next couple of years, he expects SoFi to be growing over 1 million members a quarter. And number two, that they're already working with over a dozen major financial institutions in the US currently. Now in this video, I've broken out that entire 35-minute interview into several highlights, which I've labeled, captioned, and cleaned up the audio so that we can listen in together. And just a note before we start, I've clipped some of these segments. So there might be a clip where he's talking about personal loans 2 minutes in, and then he's also talking about personal loans 18 or 19 minutes into the clip. I've grouped them together so that you have some cohesiveness in terms of the topics that he's talking about. And as I just mentioned, this is going to be a condensed video of that total 35-minute interview. The announcer started off by saying he was a SoFi member, so we're already off to a good start because this is an analyst from JPM. They started talking about the bank acquisition, what's driving deposit growth, and the trends that we're seeing. One of the interesting points that I highlighted here was that of the $2.7 billion in deposits they got in Q1, very little came from the fallout of the regional banks such as Silicon Valley Bank or First Republic. This was really interesting to me because Anthony Noto said that mostly these new clients are coming from the big players out there. He also touched on how the bank enables them to pay a high interest rate while avoiding paying them fees and allows them more flexibility around payments. I think these are all known factors, especially if you've been watching these videos for a while. We sort of reiterate on the fact that the bank charter has helped them really level up their game in general.
Deposit growth has been on a tear of late. What's driving that growth and how sustainable? Can you talk about the trends that you're seeing in deposits?
A key to our strategy is building a primary relationship with a member. One way to drive primary relationship is having someone's direct deposit. And so as we started to architect our SoFi Money product, which is a checking and savings account, we thought through all of the needs that someone would have and how to differentiate that product so we could win their direct deposit. It'd be really hard to do that without a bank, so the bank enables us to provide a high interest rate on savings and checking. It allows us to avoid paying them fees. We're in control of the value proposition. We enable you technically to pay anywhere, any way you want. You can pay a friend, you can pay a bill, you can pay via check, you can pay via wire, you can access your money in real time, you can deposit cash from your phone through a partner, you can deposit a check through your phone. And that primary relationship then gives us insights into everything else they're doing to help that person get their money right. So when we launched SoFi Money after getting the bank license, we launched it with all those characteristics, and it's really helped us drive great direct deposit growth. We delivered $2.7 billion of direct deposits in Q1, and very little of that, if any, was from the fallout that we saw amongst other banks. It's really coming from the largest money center banks, and we continue to see a very strong trend in Q2 as well. We mentioned on the call that we expected to add $2 billion plus per quarter, and we're on track to do that. And the quality of those members is very high, with a high FICO score in the 715 range, and it allows us to have 90% of our deposits from direct deposits. We also offer $2 million of FDIC insurance now, and that's allowed us to have 97% of our deposits that are insured.
Now, the announcer really followed up with how big can the deposit business grow? Anthony Noto here talked about return on invested capital. He talked about return on equity, saying that their goal is over 20% return on equity, over 30% return on invested capital. They talked about their leverage ratios and how it can go to low double digits, which he followed up to say, we have ample amount of our own capital and funding capacity. Now, what was interesting about this was that Anthony Noto also did an interview on Tuesday on Mad Money with Jim Cramer, as the capitalization has been one of the concerns that analysts have had, particularly Wedbush when David Cavarini gave the $2.5 price target. So it's really good to see Anthony Noto continuously reiterating their leverage ratios, their capitalization, and how they're doing from a metrics perspective.
Are you surprised by the success of the deposit program? And then in addition to that, how large can that be? Do you have a sense of?
Yeah, I would say I'm not surprised by the success of the amount of acquisition we've had or the deposits. The thing that has been higher than I expected was the percent of the new funded accounts that are direct deposit. It's averaged around 50%. Typically, it's about 35%. So the conversion of funded accounts to direct deposit accounts has been higher than expected. In terms of how we think about size, we really start with the end goal that we think drives shareholder value, which is return on equity and return on invested capital. And we want to drive well past 20% ROE and over 30% ROIC. That's going to be dependent on the mix of businesses that we have and the capital intensity of those and how well we run them. We have a lot of flexibility in our bank charter. Our bank holding company leverage ratio, equity to assets, is 17%. That can go to the low double digits. We have an ample amount of our own equity capital and funding capacity. And so we can continue to grow the member base through checking and savings, which will grow deposits, and we can deploy those deposits efficiently at this point in time. Over time, we may allocate more of the capital to investing or to products outside of checking and savings as an acquisition vehicle into technology partners or launch new businesses. But right now, we have a lot of runway, and it's really benefiting us.
The announcer then pivoted to personal loans, and one of the interesting facts that I found here was Noto talking about how they underwrite to cash flow, not necessarily just to FICO. They decline about 70% of applicants for personal loans who are under that 680 threshold for FICO scores, but even above 680, they then look at the credit profile. They look at the cash flow, they look at the debt profile, and overall, how creditworthy are these people? Anthony Noto continued to say that they tightened credit based on what they're seeing in the macro with a 5% unemployment rate, 2.5% GDP decline. And they talked a lot about the life of loan losses being well below the threshold tolerance.
What can you tell us about, kind of the approval rates, your underwriting posture, APRs, loss expectations, any insights you can share there? Obviously, investors are very keen and sensitive to that business right now.
One of our core values is to learn, iterate, and innovate. And so we're constantly talking about testing and learning. So even outside of this environment, we're constantly testing pricing and credit to make sure that we're managing our lending within the credit box that we've established, which we haven't changed. We underwrite 680 FICO scores and above. We actually don't underwrite the FICO score. We underwrite the cash flow. And so we're trying to predict the cash flow of that person when we're approving them. We actually decline about 70% of the applicants for our personal loans, because if you're below 680, it's a knockout. But then within that box, you still have to have a very attractive credit profile for us on a cash flow and debt perspective. So we only approve about 30% of the people that apply. The other 70%, we actually do monetize a portion of them through partners, and it's a great relationship with other underwriters that are in that credit box. We've been able in this environment to pass on the higher cost of interest rate. We call our coupon weighted average coupon, and we've been able to pass that on in higher pricing and maintain a great credit profile. We've actually tightened credit. We use a number of factors in deciding what the economic environment is, and we look at macroeconomic indicators as early warning signs, and we've used that to tighten credit throughout the last year, and we're still tightening it now. Our forecast in terms of what we think about the economy and what we factor into our credit models is based on Moody's S3 forecast, which assumes about 5% unemployment in 2024 and about 2.5% of GDP decline. So still approving around 30%, have tightened credit, have improved quality of credit. Our life of loan losses and annualized losses have been well below our tolerance threshold, so that's been really positive. And last quarter, we reported 2.97%, and we factored in a higher rate than that in our marks. So it's been a great business for us, but we've stayed really disciplined.
You touched on the loss rates in the portfolio today, I think just about 3%. I know you guys are planning for something in the 4% range. How should we think about that number trending? I know there are a lot of things going on there. The portfolio is growing, it's seasoning. Where could that 3% go, just to kind of frame that for folks and get us ready for that?
So the 3% is an annualized number. On life of loan, the duration's around 1.5 years, so that'd be about 4.5% life of loan loss rate. That's well below our tolerance of 7 to 8%. So when we think about underwriting and we think about valuing the loans and the yield that we can get, if we hold the loans versus selling them, we think about that 7 to 8% range. That's not what we're currently at, but that's the tolerance that we have. The credit could be 50 to 70% higher from a life of loan losses before it hits our tolerance. So the credit's been performing really well, and our team's done a great job.
Here in this next section, they talked about fair value accounting and how it was more transparent and accurate understanding. He was also asked around CECL, the life of loan losses, and how held for sale loans are marked in the books when they're 10 days out, 30 days out, 90 days, 120 days delinquent, how they're burned down essentially.
You're one of the few banks that uses fair value accounting. Can you explain why that makes sense for SoFi, or what, if anything, would precipitate a change in your accounting? And then just thinking about getting investors comfortable with the fact that there aren't explicit reserves. What do you tell investors on that?
We have two choices when we originate a loan. We can elect fair value or at cost accounting. Our company, since before I joined, has used fair value accounting. I will tell you, I think it's the best way to account for a balance sheet company that's using loans, because those loans have to be marked to market. If you do at cost accounting, you have to take a CECL charge up front. That charge gets adjusted over time based on losses and life of loan losses, et cetera. But the balance sheet and income statement do not change based on interest rate impacts or spread impacts, prepayment impacts, et cetera. In fair value accounting, you can choose held for sale or held for investment. Under that accounting, under fair value, we mark to market our loans each quarter. We make changes in those loans based on the change in WACC, the change in interest rate, the change in spread, the change in prepayments, every factor that could change its value, and we have to recognize it real time, and it flows through our income statement and our balance sheet. At cost accounting, companies could report an equity balance that's positive $18 billion on a Monday, and a week later actually be taken into receivership because they don't record the unrealized loss in their balance sheet or their income statement, and it's not as transparent. Fair value accounting is much more transparent, and it actually marks to market those underlying assets. And so that's what we use. In terms of any changes, once we elect fair value accounting, there's no way the accounting on those loans are going to change. You can't change from fair value accounting to cost accounting on a loan once you've elected fair value accounting. Similarly, if you go from held for sale to held for investment, the accounting also won't change if it's under fair value. In terms of losses, I think this is probably the most misunderstood thing. When we mark a loan based on held for sale on our books, it actually is assuming a loss for that loan, and then it actualizes over time. And so when we talk about a 2.97% loss rate on the loans at the end of Q1, when we marked our loans at the end of Q1, we actually assumed a higher loss rate going forward than that 2.97%. In fact, we've actually assumed about 4.5 to 4.6% based on the outlook investors have for losses and the economy. So there is an allocation for loss in the mark. More importantly, once a loan goes 10-day delinquent, we write it down by 35% through the income statement and balance sheet. Once it goes 30 days delinquent, another 35% on the original amount. So after 30 days delinquent, we've written that loan down by 70%. At 90 days, it's written down by 90%, and then at 120 days, it's written off completely. And so not only are we taking a loss assumption in the mark, we're actualizing it based on the delinquencies as they happen over time. If you think about interest rates, they've had a more pronounced impact on the value of loans on a balance sheet than any other factor in the last year. And because we do fair value accounting, if we did not hedge our interest rates on our balance sheet, we'd be taking big hits on interest rates going higher against our fixed rate loans. But we do hedge our loans, and so that hasn't happened. So I wouldn't point you to any one of those metrics. I would point you to the totality of them because that's what impacts the value of the loans each quarter. And we actually mark them monthly, internally, then externally, reported on a quarterly basis.
And the announcer continued to then ask around SoFi not selling loans in Q1. And at this point, I was starting to realize that these were also similar questions that Kramer asked on Tuesday. I started to think to myself, this is really SoFi's response, in my opinion, to the $2.5 price target that Wedbush came out with. I know some people were asking Anthony Noto and Chris Lapointe on Twitter to post tweets to basically debunk what the Wedbush analyst was saying, but this was SoFi's form, I think, of responding to a lot of those concerns that were swelling up in analysts and in retail investors alike. So the Mad Money interview, those questions, as well as these questions, the fact that they're both the same questions that are being asked on many different platforms, I think it's really SoFi's PR team attempting to get Anthony Noto in front of an audience so that he can explain a lot of these things in direct response to the points brought up by Wedbush. So with regards to not selling loans, Anthony Noto simply reiterated the fact that they can get a 6% return on asset by holding versus a 4% return on asset by selling. He also talked about how they did the same thing in 2018, which was profitable. As rates go down, the loans become more valuable for them to hold. So why would they sell them at this point if they expect rates to continue to fall?
A lot of focus recently on the fact that you've not been selling loans. What do you tell investors about that?
We're really focused on optimizing our return on equity and return on invested capital. And so when we have a choice to sell a loan at 104 or hold it at 106, we're thinking about what is the ROE. And again, we have to also factor in where are we in our leverage ratio, where are we in our ability to fund loans, and making sure we have the right balance sheet risk management. As long as we have the leverage ratio, that's 17% versus being in the low double digits, we have capacity to continue to fund. We have $3 billion of equity, $8 billion of warehouse lines, $5 billion of it's unused at the end of Q1. In addition to that, we have $10 billion of deposits. If we have room on the balance sheet, we have liquidity, we have funding capacity, we have the option to choose the best yield or best return. And so more recently, we believe we can get about a 6% return on assets by holding the loans versus selling them at a 4% return on assets. And if you think about that on an ROE perspective, that's about a 43% ROE if we held versus a high 20 if we sold. And so that's what's driving the decision. We've been in periods like this in the past where we're in a rising interest rate environment followed by a declining interest rate environment where we've made the same decision. If you go back to 2018, Fed was raising rates throughout the year. We were doing asset-backed securities deals then. The bids we were getting for residuals weren't attractive to us relative to holding them. Get to 2019, at the end of Q1, Fed's no longer raising rates. People thought they would be raised 4 or 5 times in 19. Didn't happen. All of a sudden, the bids for those residuals became stronger than holding those resids, and we sold them. So as long as we have the flexibility, we're going to pick the best return for the company.
Towards the end of the Fireside chat, they talked about the tech platform, where Anthony Noto dropped the insight that they're in conversations with over a dozen financial institutions who are facing end-of-life technologies and need a new stack. He touched on Silicon Valley Bank and First Republic, how the lack of data in real time was a hindrance that inevitably caused these banks to have problems. And he mentioned how SoFi's tech platform has the flexibility to see deposits in real time by the minute. He talked about the growth, saying that he was really confident about the tech platform growing and coming back strong from a margin perspective towards the end of the year, which is also encouraging for us to see as investors because we can expect that margin expansion to happen towards those later quarters, as that margin contraction that happened in Q4 and in Q1 was a big red flag that people were looking out for.
Shifting gears to the tech platform. Sounds like you guys have expanded your aperture in recent quarters, moving upmarket to maybe bigger financial institutions. Can you talk a little bit about that and what gives you confidence or what you're most excited about there and how quickly that can grow and be margin accretive?
I couldn't be happier with the positioning we have with the tech platform. We were not in conversations with large banks in a deep, real way prior to buying Technisys, but with the combination of both Galileo and Technisys, we're in conversations with a dozen plus large financial institutions that are facing end-of-life technologies that they're currently using for their cores, and they have to stand up a new stack. In addition to those large financial institutions, we have a number of other partners that are interested in modernize their technology stack because they want to have real-time asset and liability management. If you look at what happened with Silicon Valley Bank and First Republic, one of their biggest issues was not having real-time asset and liability management. We can see our deposits in real time by the minute. Not only can we see our deposits real time in terms of coming in and coming out, but we can tell you by customer segment what's happening and what those behaviors are. And that's a huge advantage in the world that we live in now where things can happen so quickly. So the pipeline that we have in the technology platform is very robust. These are going to be much bigger value-driving partners than what we've had in the past. They have installed bases that are large, and it will just be a matter of them switching over to the new platform. And these relationships aren't about building the new stack and converting 10 million or 20 or 30 million accounts over in one day. It's about building a new stack, onboarding new customers to that stack, and then migrating the existing customers over time to that stack. So I'm really confident that you'll see an acceleration of revenue growth in the tech platform revenue throughout the year. You'll see modest sequential growth for the next couple of quarters, and by the back half of the year, we should be back to mid-teens to 20% growth. We look at TCV, total contractual value over the lifetime, and it's at multiples higher than it's been at any point in time.
Finally, they wrapped up around AI and SoFi Travel with the Expedia partnership, and then they handed it to the audience Q&A.
It wouldn't be a tech conference without talking about AI, and so I want to hear what you guys are doing with AI.
On the tech platform, we have a product called Connecta. It's a natural language AI chatbot that helps with customer service. It's also something that we're going out to pitching to partners, and we've had great attach rates for Connecta that's using that AI capability. It helps reduce the contacts per customer, it helps improve time to resolution, and it lowers cost per contact. And so it's a direct bottom line driver, but at the same time also an improvement in customer service and customer satisfaction. So that's one place that we're using it. Second place we're using it is in the member home feed on SoFi. We're trying to answer 3 questions for you every day. What must you do that day in your financial life? What should you do and what can you do? And we're using AI and machine learning to personalize that home feed for you. We're also using it to make better personalized offers to you based on what we see from products like Relay and your checking and savings account. In addition to that, one of the biggest areas our customers in SoFi deals with is fraud. And it's the ability to implement technologies like our PRP product, which is payment risk platform at Galileo, 8 billion transactions on Galileo in a year. To use those transactions to help our customers approve authorized transactions and avoid fraudulent transactions is really valuable.
Wanted to hear more about the travel offering you guys just announced.
Partnered with Expedia to help people buy better in travel. So if you go to the SoFi app, you can see SoFi special inventory with SoFi member pricing on rental cars, on airlines, on hotels, vacation packages. When you buy, you'll get those discounted prices. If you use your SoFi credit card, we'll give you 3% back as well. Now, our rewards program is pretty robust. You can take your reward points on SoFi and redeem them into our invest product for stocks. You can redeem into cash, and now you can actually use those reward points to redeem into travel as well. And you'll see us do this in more and more categories. You could see it in autos, you could see it in entertainment tickets, you could see it in sporting tickets, et cetera, down the road. And one of the things that hasn't gotten a lot of focus in the last quarter, given what's going on in the banking industry, is our financial services segment, which is growing like gangbusters. We did over $80 million of revenue, up 4x from where it was in Q1, and the profitability is improving quite dramatically there as well. So about half of our growth in Q1 was from lending and half was from non-lending, and you'll see that trend continue to go to non-lending.
Now, with regards to the audience Q&A, I think a few interesting questions that were asked was number one, around cross-selling, and number two, what happens when the Fed starts lowering rates. So I'm going to play those clips right now.
I think the growth in the checkings and savings product is really remarkable, but could you maybe talk more about the engagement trends or the attach from that user who then goes on to use other products?
We are seeing really positive cross-buying trends. And so, we love to bring members in through SoFi Relay, SoFi Money, SoFi Invest, because they are high engaged daily use products, and then they cross-buy to other areas. You've seen cross-buying rates that have been really strong in lending. It's historically been in the mid-20s, and that's still the case. The benefit we get when someone comes in through a low CAC product like Relay or Money or Invest is that we don't spend $800, $900 in acquiring them for the loan, and that doubles the profit in the loan. So one of the things that's driving profitability in lending is the fact that 25% of the loans don't come with a customer acquisition cost, and they come at 2x the variable profit per loan. So that's really positive. I would say SoFi Money is the biggest driver of cross-buying. Invest is actually the biggest beneficiary of cross-buying. It's been, in the 40+% range of our new invest members coming from existing members. Home loans historically has been really high as well. That's been about 70+% of our home loans come from existing buyers. We're really excited about the home loan business now that we've bought Wyndham. We can have the technology capabilities in the back end to really scale that business. So you'll see the home loan business accelerate in the back of increased investment and the capability to better serve our members and reduce time to fund on purchases.
Sounds like one is kind of how does the business perform in a declining rate environment? And so I guess the expectation is that the Fed will cut rates in the back half of the year. Questions about what impact that may have on your derivative positions in the company as a whole.
What we saw when rates were low is that our student loan refinancing business really benefits as people can refinance their federal loans into lower rate loans and capture savings there. So that business would be very robust in a lower rate environment. Lower mortgage rates would also invite more refinancing, and that business would be really robust. We also see a pickup in our SoFi Invest business as there's less yield or less income from fixed income assets. People move back into equities, and so that benefits that business. And the credit card business with lower rates generally benefits because of the variable rates and the cost of it going down. In high rate environments, personal loans benefit and checking and savings benefit. There's still good demand for student loans in the private sector, given the federal student loan moratorium has existed. But in a lower rate environment, we'd see a substantial pickup in a number of our different businesses on top of the secular trend that we've already seen. And then from a value standpoint, we hedge our interest rates that are on our balance sheet. But as rates go down, generally, if you do not pass on the decline in rates in WAC, then you get an even better value for your loans. And so in an environment where we see declining rates and we can maintain our weighted average coupons, the value of loans would actually go up. If we lower our weighted average coupon faster than rates go down, then value would go down. But in an environment when rates go down, people generally hold on to the weighted average coupons longer than you would anticipate. On the checking and savings side, we would be competitive and keep our rates in the top tier, but they would likely come down as well and just lower the cost of funding there also.
And finally, the last minute of the Fireside Chat was absolutely by far the strongest out of the entire talk. So I'm going to attach that clip right after this. Basically, Anthony Noto is talking about what the future holds for SoFi in the next couple of years, and he's attaching some numbers to them. He said they expect it to double the amount of users that they're adding quarterly, up to 1 million, possibly by 2024 or 2025. and he reiterated his desire to become a top 10 financial institution globally.
And where is SoFi 5 years from now? Like, where do you see the business and 5-year goals? Not guidance, but just, where the business can go.
We've been adding about 400,000 members per quarter. I expect that number to grow. And I think by 2024, 2025, instead of adding 400,000 members a quarter, we could be adding double that, maybe even close to 1 million. And so as I think about the scale of our business, it starts with members and then products per member and then the value we generate off of each one of those products. So 5 years from now, I'd be really disappointed if we hadn't added a significant number of members. We reported last quarter at just over 5 million. If we start adding, 1 million a quarter in the next couple of years, we could easily be in the 20 million plus member range. I would hope that we have at least 2 products per member. That means some are at 4 and some are at 1. And I would hope that we were well in the top 10 financial institutions as it relates to banks from a scale of market cap as well as other measures that people use to rank banks. We will not just be in the United States. Today we operate in LATAM, primarily through our technology platform, and we have a small business in Hong Kong for SoFi, but I expect SoFi to be outside the United States as well, likely in LATAM first, given we already have a presence there with a technology platform. I hope to be a top 10 most valued brand and most admired employer.
If you enjoyed this video and if you found value from not having to dig through the entire 35-minute audio clip, but actually having some labeled segments, drop a like, subscribe, and share this video out. Thanks so much.